consider this a professional courtesy.
Hello, everyone, and welcome to a Wednesday edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, and a member of the National Association of Realtors. But please, don't hold that against me. I think it's an interesting one today, folks. The links I'm going to provide in terms of the sources for the two stories I'm going to talk about today, I think are good. It's almost a blast from the past. So much of what's going on right now feels uncomfortably familiar. We're going to talk about it. The impetus for today's show, I want to thank our good buddy Scott Blasius. He forwarded on a story he came across on January 22nd from the good folks over at Bloomberg, which kind of adds another. This is a gentleman I haven't really read quite as much as some other folks, but it's a great one. So there'll be a link in today's show notes for you to check out if you want to read all of it, or if you I also have Peter Schiff observations to share with you today. Of course, you can check out his podcast if you want to see what he has to say. Now, why do we care about these? Well, before we jump into that, of course, the best way to reach out is through the website. Head on over to therebelbroker.com. From there, you can send along any ideas, suggestions, or observations that you might have. If you are a real estate person who wants to get into the Rebel Broker Network, which is a network of real estate agents that I refer to folks who contact me, you can also reach me through the site. And if you are someone who's looking for a real estate agent who is going to pay attention to the important things, someone who is at least has a higher probability of not stinking as much as the average agent you're going to bump into. There's only so much I can do. I ask a few tough questions. I make sure that we've got someone who pays attention to the nitty-gritty details, puts your interests first, or at least as well as I can tell, and we move from there. So I feel like I can offer you someone to have on the interview roster, someone that's really going to watch out for your needs. So if you are either an agent who wants to join the Rebel Broker Network, feel free to reach out via the website. Or if you are someone who's going to be looking for an agent with your best interests at heart, feel free to reach out to me through the website as well. Okay. This is interesting stuff because we've talked about Peter Schiff before. Peter Schiff has come up quite a few times. We talked about him way back, probably almost from the beginning of the show, simply because he was one of those lone voices in the wilderness that was warning us about the downturn. Now, my show didn't start till after the downturn was really going. It was in January of 2007. We had yet to see some of the worst, but it really got started in 2006. And of course, Peter Schiff was warning folks long before then. In fact, on this show, I've shared clips where folks actively mocked Peter Schiff when he would get interviewed on some of these financial shows for laying down warnings for people that bad things were coming. And I think what you'll find is that the tenor of what's being said today about what we should think about the market is very similar from a lot of the talking heads, very similar to what we heard before the last major downturn. Now, there's a few things I want to bring together. So I want to bring together Peter Schiff and what he has to say. But I also want to bring to your attention money manager James Stack, because he's also another guy who called the downturn last time. And I also want to sort of make you aware of just the cyclical nature of real estate, because a lot of these things are coming together. We've got two guys who've been proven in the past to be very right in their estimates in terms of predicting bad stuff. Plus, we've got this historical tendency, the cyclical nature of the market that feeds into that, and the things kind of line up. And that's not even covering all the things we've talked about over the last few years about how we've been sort of rebuilding this house of cards that is not as robust as everyone thinks. Now, I don't want this to be a completely doom and gloom conversation. Given what we talked about the other day in terms of unemployment going down, the types of jobs that are being created are actual real career style jobs, potentially returning a lot of money back to the United States through the reduction of corporate taxes. And we've already seen, we talked about how that could be bad in terms of inflation, but it could be good in terms of just money going around out there in the marketplace where different companies are going to invest in infrastructure that will need people to tend to it. So we've got these things to balance. I think it's a reasonable time to sort of reassess the landscape and figure out where things are likely to go. So first, what I'd like to do is discuss the cyclical nature of real estate. Now, if you look back, at least here in California for sure, and this tends to be something that happens nationally, you're on a 7 to 10 year cycle. About every 7 to 10 years, we see things change, right? So if we look at how long it's been since the last downturn, well, it's been 7 to 10 years. We've seen a huge ramp up in prices and demand. But here's one thing where I want to point out a difference. And I'm actually sharing a graph in the show notes for today's show that sort of displays this, because I think this is an important one to keep in mind. And surprisingly enough, I think it's something that could be a very mitigating factor in our current circumstances. So let me hit it real quick. And again, you can go to therebelbroker.com and you can check out the show notes for today's show, and you can see this graphic, which I got from the Sacramento Bee, but they got it from the Construction Industry Research Board. So I'm going to share those numbers with you because I think it's an important mitigating factor. But understanding that it is cyclical and things tend to go up and down in real estate, something that also tends to go up and down in real estate is the number of homes that get built. So if we try to, and since this is such an inventory fed problem, let's just sort of look at where we are in terms of building permits per year. According to this, if we look back historically, we are nowhere near where we were at the peak of building permits. We are, in 2016, the numbers that we see on this particular chart top out at 7,206. Well, in 2002, that number was 23,378. In 1985, that number was 23,838. In 1977, that number was 22,922. In 1973, it looks like that number was right around 18,000. So we are at this ridiculous low level of permits for new housing. And that continues to be that way. Now, these numbers kind of top out in 2017. These numbers came out last year. So it doesn't include the final numbers for 2017. But that's not really the takeaway. The takeaway from this is the cycle, is the trend, right? And we've already talked about this before. Every time we've covered the number of, compared number of homes being built now versus in the past, we have been ridiculously below what we needed to be in order to meet demand. Now, here's what's interesting. And I'm basing a lot of this on my experience in terms of my estimation of volume of buyers. Given how little homes are being built in terms of new construction, I would actually say that while we're not building enough to satisfy demand, it wouldn't take a whole lot much more to meet that demand. In other words, if we were building at anywhere near the same levels, if we were building at 50% of the levels of 2002, which would put us at about 12,000, 11,000 homes being built on this particular scale, we'd about be there. In order for us to understand on average what we would see if we were building at that 2002 level, if we were up around that 23,000 mark again, or reaching parity with what was common in 2002, 2003, 2004, 2005. What we would see is way too many homes for the number of folks out there to buy. Because the reality is, if these numbers are to be believed, I should see far more people interested in each house that comes along. right? We're already in a point where you're tending to get multiple offers because of the low inventory, but it's not dozens of people. It's 2 people, it's 3 people, right? We've seen a drop even in that. The number of multiple offers on a property has really tended to go down more over the last couple of years, not so much up. We've had peaks. Last year we had a very weird peak there at the probably about 3 or 4 months into the year, which isn't horribly unusual, I guess, given when people tend to jump into the marketplace. But the point I'm trying to make here is, if we're surveying the concern, there's less concern now, right? Because in terms of the amount of homes being built, the amount of supply being put out there is so low that if we did see a downturn, a horrible thing happen, well, since there's already such low inventory, we wouldn't have this ridiculous surplus of homes like we did last time, right? So that, I think that's kind of a mitigating factor here. I think it potentially can slow down really bad things. Now, we're going to go ahead and jump in and see what Peter Schiff has to say and what this gentleman, James Stack, has to say right after this. So don't go away. Just taking a quick break.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We're taking what I think is an interesting survey of the horizon. We're talking about what's going on with real estate, but in the context of what some very accurate predictors have said in the past. Is that even a word? But also understanding there are some differences. Now, I just pointed out a difference that I think works for us. The fact that we haven't seen the gigantic buildup in properties. We haven't seen tons of residential building going on. It's really been a small fraction compared to what we saw at the last peak. So in terms of the inventory being created, you could call that a gradual recovery, I guess. But because of the hesitancy to build more units and because no one's been jumping out there and really meeting the levels of demand, what's that equal to is a crazy ramp up in prices. So while that limited amount of inventory that's been coming up on the market could mitigate some of the downturn, it sure does seem to me that at some point these prices have to adjust. Everything is so out of whack in terms of demand and supply that when those things do get back into whack, I don't see how you anticipate anything other than a drop in prices. But it really depends on what's going to happen. There's some interesting points made in these articles. We'll start with the article from Bloomberg. And again, you can check these out. There's going to be a link to it in the show notes for today's show. Title of this one is "This Rare Bear Who Called the Crash Warns Housing is Too Hot Again." Prices are through the roof and builders' shares are soaring. Montana money manager who called the crisis is seeing red flags. Stack, who manages a $1.3 billion for people with a high net worth, predicted the housing crash in 2005, just before prices reached their peak. Now from his perch in Whitefish, Montana, he says, quote, "His housing bubble bellwether barometer of home builder and mortgage company stocks, which jumped 80% in the past year, once again is flashing red. Quote, it is 2005 all over again in terms of the valuation extreme, the psychological excess, and the denial. People don't believe housing is in a bubble and don't want to hear talk about prices being a little bit bubblish. And nothing could be more true than that. That's why so much of what's going on right now feels so familiar. It feels an awful lot like it did the last time we had this happen. There are so many pundits out there that simply don't even want to have the conversation and want to really list off all the wonderful reasons why nobody should be worrying. Now, the housing market, according to them, is approaching its key spring selling season, which is totally accurate. Stack is practically alone in his wariness. While price gains may slow, most analysts see no end in sight for the 6-year-old recovery. And then they kind of list off some reasons why they're optimistic. So let's cover theirs, right? Let's see what they say are reasons why we shouldn't worry. The housing needs of two massive generations, millennials aging into home ownership and baby boomers getting ready for retirement, are expected to fuel demand for years to come if employment remains strong. And there's no reason to think it won't. There's in fact, with some of the things we've seen just in the news recently, there's reason to believe that there'll be infrastructure improvements that will be implemented over the next year that'll continue on that will feed good employment. So those are all good things. It goes on to state that sales in master plan communities, many of which target buyers who are at least 55, reached a record last year, according to John Burns Real Estate Consulting. Last month, a gauge of confidence from the National Association of Home Builders, Wells Fargo, rose to the highest level in 18 years, something we covered here on the show. And starts of single-family homes in November were the strongest in a decade, but still suck. So let's be real clear about that. Home builders, which have focused on pricier homes since the market bottomed in 2012, are now getting ready for a wave of first-time buyers left with little to choose from on the existing home market. Investors are rushing to builders for starter homes because low-priced homes in the U.S. are in the shortest supply. Shares of LGI Homes Incorporated, which targets renters with ads that trumpet monthly payments instead of prices, rose 161% last year. D.R. Horton Incorporated, the biggest builder powered by its fast-selling Express entry-level brand, gained 87%. So, all of these gains in terms of people having faith in the builders, it looking like builders are moving towards meeting the demand, all sounds good. It also sounds like it could be that thing that starts to mitigate ramping up home prices. Quote from, Samantha Micklemore, who manages Bill Miller's Miller Opportunity Trust, says, over the past year, we've really seen a pickup in the first-time buyer, and that's what's driving a lot of the stocks for these manufacturers. Stack, our guy who got it right last time and has a little bit of a more cautionary approach, says, while the market might gradually correct itself, history shows that it's more likely to come down hard with the next recession. He described the pattern as a steep run-up in housing prices spurred by low interest rates. The last downturn came about when economic growth slowed after a series of rate increases, exposing the rot in the woodwork and prompting loan defaults. He noted that the Fed has projected 3 rate increases for this year and said that raises the risk that today's highly inflated housing market will again end badly. He's watching home builder stocks closely because they're a leading indicator, peaking in 2005, the year he called the crash, and the year before home prices themselves hit a top. He's been studying median home prices too, which typically track long-term inflation as measured by the Consumer Price Index. Last summer, they were as high as 32% above that measure. In 2006, just before the housing bust, values were about 35% higher than that mark. According to the data from the National Association of Realtors, half of the 50 largest metropolitan areas were overvalued relative to incomes in November, compared with 36% 2 years earlier, according to an analysis by CoreLogic. So these are all interesting numbers. I think they set an interesting stage because, again, all of these numbers are mirroring what we saw just before the last downturn. And as we've talked about here on the show before, I'm taking actions in my own life that I think demonstrate my belief that these are interesting observations to make and that they are worth considering getting off the bus now in terms of pulling value out of your home by selling it and then potentially riding a wave of downturn. But here's what's interesting. Given what we've seen, I'm not 100% convinced, despite the fact I think economically things aren't as robust as they were in 2004, 2005. And the fact that we've talked about here on this show that was a concern for me. Because of what's happening in terms of the overall inventory that's been created, I think it potentially offers us that element by itself offers us a little bit of comfort in that I don't think that we see property values potentially drop as much as they did before. I think that if we did start to see a downturn and they could continue to build at the level they're building now and see reasonable returns on those buildings being put up. There's one more thing that they mentioned here that I thought was interesting, because we've talked about it here in terms of just the tax changes and what those might bring to the economy. One wild card is the tax overhaul, which could cut both ways for home builders. They got a lower corporate rate, and many of their consumers will benefit from the doubling of the standard deduction, but it also caps the mortgage deduction at $750,000 instead of $1 million and limits deductions of property taxes, which might hurt expensive markets such as New York, New Jersey, and California. As a result of the tax plan and an expected gradual rise in mortgage rates, existing home sales will be flat this year, and prices will rise only 1 or 2%. That's according to Lawrence Yun, the chief economist for the National Association of Realtors, who's not one of my favorite guys, and I've made that clear. We've talked a lot about what Lawrence Yun has said in the past. Lawrence Yun is frequently wrong, but wrong in the way you'd expect someone who's talking for the National Association of Realtors to be wrong, right? It tends to say things that push the side of the equation that will create enthusiasm in the market, because the National Association of Realtors only makes money when there's more real estate agents, right? They want more agents paying the dues. They want more agents paying for leads off of Realtor.com. They want enthusiasm, right? So that's how their business model works. According to Yun, quote, the housing market has been doing relatively well during the recovery, but 2018 will be a year where we begin to see some change. It's almost better for the stocks if the general consensus is for moderate growth rather than supercharged growth, according to Carl Reichert from BTIG LLC. New home sales will probably increase 8 to 12% this year after rising about 11% in 2017, according to Alex Barron with the Housing Research Center in El Paso, Texas. So some caution, I think, worth listening to there. This is definitely a guy who has called it in the past and is seeing some of the same road signs in terms of statistics that indicate to him that at the very least we're going to see slowing this year. If the timing is the same, right? If we assume that a lot of these indicators that he saw back in 2004, 2005 are indicators, he started to see this stuff about a year before the downturn really kicked in, right? It was when they were just about to reach the peak. That they mentioned here that he made these observations. The market made its peak within a year, and then things started to decline from there. So definitely everyone, if we assume the same time scale, we would expect everyone to have some time to decide what they want to do about these particular numbers. All right, so next, let's talk about Peter Schiff. This time, we're looking at a story from Zero Hedge, and I realize Zero Hedge can sometimes be out there, but this time it's really just focused on Peter Schiff and what he has to say. I'm going to strongly suggest that folks find some time to take some time out and listen to Peter's podcast. Episode 314 would be a good one. According to the folks in this article, the weakening of the U.S. dollar is just getting started, warned veteran market forecaster Peter Schiff. Quote, we have just begun a major long-term bear market in the dollar, end quote, he said, which should cause a spike in oil prices. He thinks oil will reach $80 to $100 a barrel in 2018. When the price of oil rises, it reverberates through the economy. Peter called it a gigantic tax hike for consumers, but the Fed is still worried prices aren't going up fast enough and that they won't hit the mystical 2% goal. Schiff also warns that the dollar's decline is just getting started. He says everything that can go wrong will. We are not experiencing economic growth. We're experiencing inflation. Sadly, I think the inflation part of that equation is likely to be a correct thing. And just given what we've talked about in terms of what will happen with the repatriation of so much cash from corporations offshore, remember, in terms of actual commitment, we've already got enough companies talking about bringing money back that'll total over $1 trillion. Now, there's twice that out there. There's $2.3 trillion, and I think we already have committed $1.1 trillion, but that's a heck of a lot of money. So you bring that back in the United States, and that's going to cause inflation. He goes on to say, quote, high inflation is not good for the dollar. By definition, high inflation means the dollar is losing purchasing power, which we talked about on the show the other day. If the dollar is losing purchasing power, that is bad for the dollar. He goes on to say, if they, the public and investors, don't think there's going to be inflation, they're wrong. Those expectations are totally wrong. People are ignoring what is going on in the currency market, what's going on in the commodities market, what's going on in the bond market. All of this stuff is flashing inflation, at least the way you measure it, consumer prices. So he doesn't even bring up the stuff that was discussed recently relating to repatriation of funds, which will push inflation beyond where he's talking about. He goes on to say, quote, "We are very close to a major breakdown in the bond market." Now, I know the bond market has dodged a lot of bullets, so you could say crying wolf. Look how long the bond market has held in there. But you know what? It's going to hold up until it doesn't. And when it breaks, this bond market is going to unravel. The whole thing could unravel very, very quickly. This is what is so dangerous here. You have the bond market potentially about to break down, a major 30-year bull market about to unravel. You have the dollar getting ready to go over the edge of a cliff. Everybody believes the Fed is going to shrink its balance sheet. Now, I don't believe that, but the markets believe it. Now, I checked the balance sheet on Thursday again. So far, it hasn't shrunk at all. So there's been no tapering. Now, remember what we talked about. Tapering is when the Fed buys back some of those bonds. In other words, is basically reducing some of that influence in terms of creating more inflationary influences. The risk of a big drop in the bond market has never been this high. And what happens if the bond market tanks? That's it. The stock market is going to crash. There's a massive crash coming. And if the Fed is going to panic, they're going to try to stop it. So that also feeds into other things we've talked about. Think about pensions, right? There is, again, trillions of dollars of unfunded pensions going on out there. And another problem would be if it does get bailed out by the federal government, that's printed money. We talked about velocity of money, and bailing out pensions is super high velocity because it puts money right into the hands of people who are going to then go out and spend it on stuff, as opposed to what happened last time, which was printing up digital money, which really just moved from one bank to another as people sold homes and just paid off and bought new, right? You don't usually end up with that money actually in your pocket. It just goes from one institution to another. I don't know if it's going to unravel very quickly, but it is close, Schiff warns. So Schiff is not optimistic. And the thing that creeps me out is I was actually listening to Schiff way back before the last downturn, and a lot of his concerns weren't in the exact same lane as concerns I had. At that point in my real estate career, I was just really concerned with some of this crazy lending that was going on, 110% loans, stated income, people coming in and just bidding way over asking price. So much of that is going on now. It's very concerning. Granted, it's a slightly skewed edition of that. We typically don't have folks coming in and getting 110% loans, but remember, we've talked about how you can get those. In fact, we can get 120% loans if you roll your student debt into your mortgage. They'll let you borrow at that level. So there's examples of it. We've got examples of the quality of your credit score being manipulated so that you appear to be more qualified than you are. In other words, we're taking people who would normally be considered subprime lenders, and because of the new way we're figuring out credit scores, you're being considered a not subprime borrower in ways that don't make sense. These aren't rational changes. Your phone bill, your electric bill, your water bill should not be things that count towards your credit score. Why? Because these are things people just get turned off when they don't pay them. It's about securing assets with debt that builds your credit score, right? That you service. So lots of crazy stuff. If you want to get a refresher on that, go ahead and check out the website, therebelbroker.com. Lots of shows done last year on this topic. But that's sort of the broad view. If you want to go and read more detail, of course, you can hit the show notes for today's show and check out what they've got to say. I think this is a perfect time for folks who are in investing who own property. Even if you're someone who just is trying to decide if this is the right year for you to sell your home and potentially consider making a change, I think this is a good time for you to make those assessments. We've got a situation where two other folks who were right are saying they're seeing things that feel very much like the year before last time things went bad. So hopefully this is information that's going to give you enough warning that you prepare. And even if it doesn't mean you necessarily sell your home, maybe you simply prepare yourself for what is going to come to survive it as you stand, right? To keep your home, to weather the storm. Do things now. Do things that will help you survive a potential downturn and be aware of it. Maybe you don't spend crazily. Maybe you save a little bit more, or maybe you convert more assets. Maybe you make some moves you wouldn't have made otherwise. But definitely take some time to consider it, because I think it's going to be a valuable process for you. Even if you look through everything, you examine your standing, you examine what these guys are thinking, and realize you're okay. That's good. Then this has been valuable information for you. And of course, the goal is to always give you valuable information. Hopefully, we've given you far more good things, or at least useful things to think about than the time you've invested in listening to this show. Thanks again for taking the time out and spending your valuable time with me. I do truly appreciate it. I'll talk to y'all next time.